$400 billion. That is exactly what AI hyperscalers are burning through every single year right now just to build out data centers. I mean, think about the sheer scale of that for a second. They've literally quadrupled their spending in just 2 years. And get this, that single massive line of infrastructure spending, it single-handedly drove 92% of the United States GDP growth last year. Without it, the entire economy would have grown by a microscopic 0.1%. But here's the catch. All of those massive data centers demand one thing above all else, an absolute mountain of electricity.
Welcome back to The Explainer. Today, we are unpacking one of the most fascinating macroeconomic shifts happening right now: how the explosive AI boom is directly triggering a massive surge in profitability for nuclear energy. The big tech giants realize they need clean, uninterrupted 24/7 baseload power to run their vast AI operations. And to get it, they are turning to the grid's absolute heaviest hitter. So, here's our roadmap for today. First, we'll look at the AI energy shock. Then, we'll dive into the economics of the margin machine. Third, we're deconstructing the stack. And finally, we'll map out the 10-year long game. Let's just dive right in. Part 1, the AI energy shock. So, tech giants like Microsoft, Amazon, and Meta, they've realized the current grid simply cannot handle their future AI power needs. They're not waiting around anymore. Instead, they've started aggressively signing these things called PPAs directly with energy providers. Now, if you aren't familiar, a PPA, or power purchase agreement, is basically a long-term electricity supply contract. By signing these, tech hyperscalers are guaranteeing they'll buy electricity at a negotiated, set rate for literally decades to come. This provides absolute financial certainty for the power plants, allowing them to confidently supply those incredibly power-hungry data centers without sweating the risk. And when we say massive deals, guys, consider the scale here: over $200 billion. If you tally up all the power purchase agreements, the equity stakes, and the co-development deals currently in motion between big tech and nuclear providers, that's what's sitting on the table today: $200 billion. This isn't just theoretical anymore. The capital is already being deployed at a truly breathtaking pace. Which brings us to part 2, the margin machine. So how exactly does this $200 billion translate into wildly profitable economics? Well, right now, natural gas generates about 43% of all electricity in the US. Because it's the swing producer, meaning it can be quickly turned up or down to meet demand, natural gas actually sets the wholesale electricity prices on the broader grid. But gas prices are incredibly volatile. Things like an extreme summer heat wave or global geopolitical events can send gas prices soaring, which pulls grid electricity prices right up with them. On the flip side, you have nuclear. A nuclear plant's fuel costs are locked into fixed contracts for 20 years or more. Their fuel costs essentially do not move. So here is the absolutely crucial point. When gas prices spike and drag wholesale electricity rates up, nuclear power plants automatically capture all of that upside as pure margin. Their revenue shoots up, but their costs stay exactly the same. That right there, that is the margin machine. All right, part 3, deconstructing the stack. The nuclear industry can seem overwhelmingly complex, like a giant puzzle, but we can actually organize this whole ecosystem into a very clean 4-tier hierarchy. Think of it like building a pyramid from the ground up. At the very foundation, we have Tier 1, the miners, who pull the material from the earth. Above them is Tier 2, the fuel cycle companies who process and manufacture it. Then Tier 3, the innovation reactors designing the future. And sitting way up at the top, Tier 4, the operators who actually generate the power and sign those massive PPAs. Let's break each of these down, starting right at the bedrock. Down in Tier 1, the feedstock flows into literally everything above it. The absolute heavyweight here is Cameco. They pull massive weight, accounting for roughly 14 to 20% of all global uranium production. But here's the really fascinating twist. Cameco also owns 49% stake in Westinghouse Electric Company, which is a major reactor builder. So Cameco is capturing economics from both ends. They mine the uranium out of the ground, and they profit from the reactors that end up burning it. Now, we also see essential pure play miners in this tier, like Energy Fuels, who operate the only conventional uranium mill in the US, along with Uranium Energy Corp, Paladin Energy, and Denison. But Cameco's integrated story definitely stands out as a unique foundation. Moving one step up to tier 2, we hit the fuel cycle. This is where the supply squeeze is hitting the absolute hardest right now. Centrus Energy is uniquely positioned here. Following bans on Russian-enriched uranium, the domestic market blew wide open, and Centrus, they saw their backlog explode from almost nothing to over $2 billion in just 2 years to fill that massive domestic gap. Alongside them is BWXT, the only large-format commercial nuclear equipment manufacturer in North America. Their commercial backlog surged an incredible 85% year-over-year. A huge part of that is driven by their manufacturing of TRISO nuclear fuel, which is the exact fuel architecture required by nearly every single advanced small modular reactor currently in development. Next up, we reach Tier 3, Innovation. These are the high-risk, high-reward, small modular reactor moonshots. You've got Oklo, backed by Sam Altman, who are targeting major criticality milestones for their microreactors by mid-2026. Then there's NuScale. Now, strictly sticking to the facts here, NuScale is currently navigating an active securities fraud class action suit. However, concurrently with that legal headwind, they are still actively pushing toward crucial NRC design certifications for their 77-megawatt integrated design. Finally, in this tier, you have the Amazon-backed X-Energy. They recently went public and secured a staggering commitment from Amazon to deploy 5 gigawatts of their high-temperature gas reactors by 2039. And finally, we reach the apex of the pyramid, Tier 4, the operators. These are the actual utility companies signing the multi-billion-dollar PPAs with tech giants and fully realizing the profits from that margin machine we talked about earlier. Constellation Energy leads the pack as the largest U.S. operator with 33 gigawatts of capacity. They're the ones who just locked in a 20-year deal with Microsoft to literally restart 3 Mile Island. Then you have Vistra, who recently signed a massive multi-gigawatt deal with Meta. And Talon Energy, man, what an incredible turnaround story. They emerged from bankruptcy at roughly $38 a share and shot up tenfold after securing a 1.9 gigawatt anchor deal directly with Amazon. Seriously, if you want concrete proof of that margin machine thesis playing out in real time, just consider Vistra's free cash flow. In 2021, they were burning through negative $1.2 billion. Negative? Just 24 months later, by 2023, that flipped to a positive $4 billion in free cash flow. That is a wild, almost unbelievable financial flip over just 2 years. Why did it happen? Because global gas and power prices surged, but Vistra's nuclear fleet just stayed online with fixed cost economics, printing pure margin. Finally, part 4, the 10-year long game. Look, this is not some quick 3-month phenomenon. We are looking at a decade-long infrastructural mega trend that is going to literally rebuild how power is consumed in the modern world. To really understand where the conviction levels sit across the industry, let's imagine a hypothetical $100 allocation model. Notice where the heaviest weight naturally sits. $50, half the allocation, firmly anchors in those Tier 4 operators. Why? Because they are the ones signing the long-term agreements today. They hold the highest immediate conviction. Then $25 goes to the Tier 2 fuel cycle as a leverage play on that intense supply squeeze. $15 grounds the portfolio in the Tier 1 miners, the fundamental source of all the supply. And finally, a $10 slice is reserved for the Tier 3 innovation moonshots. That's the high-risk layer where future fortunes might be made. You know, if those reactor designs hit perfectly. The reality check here is that building the grid takes vast amounts of time, which is why this is the ultimate long game. Just consider the milestones ahead of us. Oklo is targeting criticality in 2026. X-Energy is aiming for design certification around 2027 or 2028. Constellation's massive 3 Mile Island restart for Microsoft, that isn't even slated to connect to the grid until 2031. And Amazon's 5 gigawatt deployment with X-Energy stretches all the way out to 2039. The main takeaway here is that supply constraints are going to hit the market long before this new power is actually deployed. Now, quick aside before we wrap up, it's definitely worth noting that for those who follow these macroeconomic setups but, prefer not to sift through individual company risks or deal with single stock volatility, There are multiple diversified ETF options out there. These funds basically offer simpler, automatically rebalanced exposure to this exact nuclear infrastructure trend, spreading the risk across all the various tiers we just explored. We have covered an incredible amount of ground today, right? From a $400 billion AI spending spree to fixed cost margin machines generating billions in free cash flow. But I want to leave you with this final provocative thought. For the last 20 years, the massive tech hyperscalers dictated the terms to absolutely everyone else. But right now, as artificial intelligence literally eats the electrical grid, look at who is forced to sign the 20-year locked-in contracts just to secure their own future. So I ask you, in the decades to come, who truly holds the power? Thank you so much for joining me for this explainer. Keep asking great questions, and I will see you next time.